rápido. Chapter 6: The Wizard of Fate. Inevitable, the nation's first subprime bond ended badly, and its first iteration in the mid to the late 1990s to the subprime business had only emerged on the classic bubble. Subprime companies would go public and their stock would skyrocket. Company founders got rich making loans to the people who had never before been able to qualify for a mortgage. The first crack in the facade came when a crowd of companies specializing in the subprime auto lending went belly up amid rising delinquency rates. To compound matters to the subprime mortgage, companies began taking on spec write-downs. It had long been to common industry practice for the subprime companies selling loans to the Wall Street to keep what were called the residuals. These were the richest piece of the securities, the one that nobody else wants. For most of the time, they were the ones that came with the highest prepayment risks. Accounting rules required the companies to estimate the future value and the cash flow and book the upfront profit, which they very aggressive. What is more companies enter to the business, they began to poach from each other rated financing borrowers. More refinancing meant more people prepaying their mortgage, increasing the already overloaded residuals as one subprime originator after to another took big write-downs on their residual years on the supposed profits we earned. Josh Runner, who was the analyst on the Oppenheimer Securities, he played a hand in taking many of these companies public. They were liars, he says now. Spoked while the write-downs Wall Street began to pull the plug on the subprime machine, while dragging to the warehouse loan to the had been its late flood. One after another, the companies went bankrupt, and much of their supposed profit turned out to be illusory. One company, First Blood, had reported 86 million in earnings in the first 9 months in 1997, would have eaten through in cash and had to raise stunning $1 billion in Wall Street financing, according to the presentation given by hedge fund manager Jim Chanos. Thus were the kinds of the results that can exist only a bubble. In 20 years, First Union shut down the money stock. The subprime lender had bought just 2 years earlier for $2.1 billion, and the end of the day we're saying we made a bad acquisition. First Union CEO G. Kennedy Thompson to the New York Times. Along with their bankruptcies came a wave on the lawsuits and the complaints from consumer advocates who accused the subprime industry of engaging in predatory lending. Customers, they say, had been cooled into taking expensive mortgage and paying exorbitant fees by unscrupulous lenders. Many subprime refinancing replaced simple 30-year first mortgage. We and others were saying to Fed, state legislator, anyone who would listen in D.C. that lending was getting out of control, says Kevin Stein, the associate director of the California Reinvestment Coalition. Even back then, There was a legitimate debate over who ultimately was more culpable, the lender or the borrower. After all, borrowers often want to get their hands on the money every bit as much a lender wants to give is to them. Not everyone was paying gold. Many borrowers were using the rising values on the homes and the life beyond their means. But in the larger sense of things, it didn't really matter who was at fault. The key point was this. A lot of people were getting loans to the couldn't pay back. Wasn't that a real problem? Prior securitization lenders had to care about the credit worthiness of borrowers. They held the loans on the books, and borrower default. They took the hit. That's why borrowers who didn't have much money couldn't get mortgage. Lenders were afraid they would default. Securitization severed that the critical link between borrower and lender. When a lender sold a mortgage was straight, repayment became someone else's problem. The potential consequences of this shift were profound. Some lands on the heart and some banking system, and some lands on the solid road to the disaster. But at the time, almost no one seemed to realize that the wave of the poorly underwritten loans the securitization seemed to encourage was a monstrous red flag. The subprime business back then was still relatively small. The collapse on dozens of subprime companies didn't remotely threaten the banking system. It didn't have much an effect on the housing market either, but it was still significant for the bank regulator charged with ensuring that the banking system remained sound. This was the canary in the coal mine moment, the signal that something was seriously wrong, or rather, it should have been. Is Alan Greenspan memoir, The Age of the Turbulence, a 500-plus-page tome published the year before the financial crisis. The phrases subprime mortgage and the predatory lending don't merit so much condemnation. Greenspan booked a triumphant account on his 18.5 years as fisherman. Years during which, by his account, he put out economic crisis, kept inflation under control, and deftly manipulated interest rates to ensure that the economy hummed and the market rose. Before the financial crisis tarnished his reputation, Greenspan a self-image. Fisherman as economic superman was widely shared. Congressman Phil over Thompson to praise. When he made his semi-annual appearance on Capitol Hill, his interest rate decisions were invariably lauded. Many economists viewed him as the greatest Fed chairman ever, even greater than Paul Volcker, who had tamed the rising inflation on the 1970s. The small hundred of former journalists who had on the one record to access to the Greenspan regurgitated his pronouncement, and as they had been handed down by the Oracle of Delphi. Too many people, Greenspan was the Oracle of Delphi. Although the country was understaffed, fixated on Greenspan only on the monetary policy. The Fed had always had another role too. It had supervisory authority over the big bank holding companies. It was supposed to the guardian of the safety of the soundness and the banking system. It had even had a division of consumer and community affairs to look after interested and bank consumers. The Fed In other words, was a regulator which spent, however, was not. As a young economist, which span had come under to the spell and Ayn Rand, to the author and the Fountainhead and Atlas Shrugged, two of the most influential odes to capitalism ever written. The capitalism Rand believed in the was full, pure, unregulated, laissez-faire capitalism, and she once purified the kind that didn't pure regulatory roadblocks in the way and the red-blooded entrepreneurs met Rand in the early 1918 became part of the inner cycle and remained close to her until she died in 1982. A conservative economist like Greenspan is able down to detail against regulation, but Rand have and his learning a philosophical underspinning and helped turn him into a true first maker absolutist. He came to believe that the regulation always had unforeseen negative consequences, and the market itself was better at praising to the good and driving out the bad than any well-meaning government mandate. That's what he meant by the market discipline. Greenspan's regulatory philosophy did not prevent him from working for the government. However, as an advisor to Richard Nixon's presidential campaign in 1968, he reasoned that it was better to advance free market capitalism from the inside, rather than a critical pound leader. He says, in the age of the turbulence in 1974, President Ford asked Greenspan to become the chairman of the President Council and economic advisor. I knew I would have to place to follow not only the Constitution but also the laws on the land, many of which I took were wrong. He writes. He concludes compromise on public use the price on civilization, not one abrogation of principle. There is no question, looking back, that Greenspan Federal Reserve could have taken steps to cure the growing problem with subprime lending before they got worse. It had the authority. There was law and the book called the Ownership and Equity Protection Act of OEPA that gave the Federal Reserve the power to take the private mortgage lending practices that it concluded were unfair and deceptive or designed to evade OEPA. The Federal Reserve ample authority to encompass a type of mortgage loans within the scope of any regulation in promulgate. Wrote Raymond Nader, a lawyer who got worded in the bill when he on the state and the Senate Banking Committee. There is also no question that problems with subprime lending were a secret. After the crisis in 1908, a common refrain arose that no one said is coming, but that was never true. The state attorney in general had filed lawsuits. Housing advocates had continually beating to the terms, and in a graphic detail, Congress and the regulator, including Greenspan, has been told what's happening on the ground. Robert Gaista, then the General Counsel on the Grenelling Institute, which, among the other things, advocates for the consumer protection for people on the diverse backgrounds, started meeting with the Fed chairman in the early 1919. He raised the problem on the money mortgage originator that exists outside the banking system and were unsupervised by any federal agency. We won't argue about whether federal regulators are doing a good job. Nice that says he told Greenspan. Let's look at the unregulated lender. He had no objection other than saying he wouldn't do anything. Greenspan says no. He was very gracious and polite, but there was also an imperious quality to him. A few years later, Naisda and John Gamboa, currently executive director, meet with Greenspan again in advance of the meeting. Naisda had sent to the Fed a pile of loans documents, which Greenspan had read. Even if you had a doctorate in a math, you wouldn't understand this instrument and their implication. Greenspan alleged during the meeting the Fed chairman has just given a speech in which he has famously recommended adjustable rate and mortgage. John Taylor and the National Committee Rent-Based Collocation was another housing activist who used to meet with the Fed. Their response was the market wouldn't correct any problem. Taylor says Greenspan in particular believed that the market would not produce, and investment banks would not buy loans that didn't make sense. He genuinely believed that. But anyone who knew anything about the subprime business could see that wasn't true. A prototypical example was Alliance Mortgage Company, or FANCO. Started on the early subprime, FANCO went public in 1996, allowing the founder and his wife to take out on the company, waiting 2 years. However, its abuse had become to the widespread, and so we know that several state attorneys sued the first company to the stop. FANCO's abuse were not the result of a few bad apples. They were baked into the company business model. As former loan officer Greg Walling explained in an affidavit, FANCO recruited to auto salesmen who knew nothing about mortgage and have them memorize something called the track, which was a how to the hard sell. Did Wall Street know what was going on? You bet it did. FANCO told its investors that modern subprime loans when the people with relative got credit, which meant borrowers were essentially paying ripped off, since they didn't need to pay a big fee to get a good rate. In 1995, Eric Hoover and Lehman Brothers executives wrote a memo, later obtained by the board, to the Wall Street Journal and the New York Times, describing FANCO and a sweet shop, specializing in high-pressure sales for people who are in weak state. He added, "It is a requirement to leave your ethics at the door." The Lehman Brothers to decide couldn't do business with a company as Lilly FANCO. Of course not. Starting in 1998, the same year, and the state fight suit, Lehman gave FANCO a warehouse line and helped in the mortgage-backed securities. According to the one lawsuit, the shoddy quality of the loan seems to have been much on the minus for Lehman as was for FANCO. Saying Wall Street has just paid into the loans along to the investor. It didn't have to care whether the money will be paid back. In the 20 years, FANCO declared bankruptcy. A jury later found to the company had systematically defrauded borrowers. Lehman was found guilty on the aiding and abetting to the fraudulent exchange, with the French punishment and the $5 million fine was negligible. This was American discipline, good practice, driving bad ones out. It was the opposite. Bad practices were driving out the good ones in the mortgage industry and the lands. Rispat's beloved theory was being blown to the smithereens on the daily basis, and still he refused to do anything. Actually, that wasn't quite true. In the spring to 20 years, Greenspan announced the formation of a 9-agency task force, including a bank supervisors, to look into the predatory lending. By the complaints and the lawsuits had become so numerous that Washington officials could scarcely keep ignoring them. The Senate had held hearings. 3 prominent senators, including Paul Sabernes, the ranking Democrats on the Senate Banking Committee, introduced bills into the ban predatory lending. The Treasury Department and HUD put together a national predatory lending task force. In conclusion, in a 23-year report, Treasury and HUD believed that new legislation and new regulation are very essential. The Federal Trade Commission started bringing cases. Sarbanes for one knew the terrible damage predatory loans could do. Baltimore, in his home state of Maryland, had been hit hard by recent foreclosures. Many of the results on the subprime lending abuse, but the chairman on the Senate Banking Committee Pilgrim opposed any move to regulate subprime lending. His staff on the Senate Banking Committee issued a report saying that it made no sense to regulate predatory lending practice because it was impossible even to say what predatory lending was. And Greenspan didn't act. The fifth preferable solution seemed to be more disclosure, so that borrowers could be better understand the terms on their loans and make informed decisions. More disclosure appealed to his libertarian instinct, but as everyone in the mortgage business knew, in Christ, disclosure had gone virtually nothing to stamp out lender abuse. Over the years, there had been numerous disclosure requirements added to the loan, yet to the average home buyer, mortgage documents remain legally incomprehensible. I don't think there is such a thing as a real sophisticated borrower. Bill Dallas was founded a subprime company called First Franklin in the 1917. Sold to the American bank in 1998. Basically, they put their lives in the hands of the originator, and we guide them. Phil Lehman, an assistant attorney general in North Carolina, described disclosure status to the Fed official in 20 as the last refuge on the scoundrels. One thing that the Federal Reserve was required to the under the 1994 HOEPA law was held hearings from the time to time to gain an understanding of the latest problem in lending industry. In 20, it held a series of the HOEPA hearings in San Francisco, Charlotte, Boston, and Chicago for anyone trying to understand why regulators were having so much trouble dealing with predatory lending, this hearing, and illumination. Not long After his arrival on the Fed in 1997, James Lynch was asked under Chris Penn to head up on the Fed Committee on Consumer and Community Affairs. This was a not prestigious post for a Fed governor, and James knew very little about the subject, but he done in early becoming one of the country leading experts on the subprime business, and one of its leading critics. In 1907, Graham Lynch wrote a short book entitled Subprime Mortgage, America's latest boom up bust. In the supermarket, the world, where we battling net supervision, a majority of land are with very little supervision. It's like a city with a murder law, but no cops on the boat. Graham Lynch, however, was not temperamentally suited to the cop on the beat. As the hearing opened, he explained that the purpose was to see whether to the HOEPA regulation should be right to the first lender to the consider to the consumer ability to pay. Given what would happen in that, given what's already happening, it would be hard to think of the more important line inquiry. Young Lynch questions were to the so much answers and the word prayed, and he was too gentle a soul to push back. One of the people rectifying the day, for instance, was Sandor Samuels, the chief legal counsel for the Countrywide. He objected to the idea that the borrowers should be required to disclose their income, something you would never think lenders would want to know before making a six-figure loan. Let me just say, very briefly, that we think is very dangerous area to get into. Graham Lynch. The obvious question is, if you can document that income, how do you know they can pay to the loan bank? Sounds right. And I would say there are certain reality checks. Let's just say, is a waiter in the restaurant views now that he or she is making $300,000 a year. We're going to ask what kind of restaurant they're working at. Greenwich ended the hearings by more on the throwing up his hand. There are many practices that might be good most of the time, but N is abused some of the time. So it's difficult to simply ban practice. He says, should the government try to discourage house flipping? If it did that, it might also prevent people from taking advantage or failing interest rate. Should it forbid balloon payments for certain borrowers upon